Imagine waking up one morning to find your life savings have vanished. This happened to many people in 2008 when the housing market crashed. It was a financial disaster that affected people all around the world. Homes were lost, jobs were gone, and families were left struggling. But what causes these financial bubbles to form and then burst? It's a question that has puzzled experts for centuries. The Dutch Tulip Mania of the 17th century is a famous example of a financial bubble. People were buying and selling tulip bulbs for crazy prices. Some bulbs cost more than a house. It was a time of great excitement and speculation. But when the bubble burst, many people were left with nothing. They had spent all their money on tulip bulbs that were now worthless. This event was one of the first recorded financial bubbles in history. It shows how people can get caught up in the excitement of making money and lose sight of reality. The Stanford Prison Experiment is a famous study that helps us understand how people can get caught up in a bubble. In 1971, a group of students were divided into prisoners and guards. The experiment was meant to last for 2 weeks, but it was stopped after just 6 days. The guards had become too aggressive, and the prisoners were suffering. This experiment shows how quickly people can get caught up in a situation and start to behave in extreme ways. It's similar to what happens in a financial bubble, where people get caught up in the excitement and start to make irrational decisions. The question is, what happens in our brains when we get caught up in a financial bubble? Do we really think we can make a fortune? Or is something else going on? In 2019, a team of neuroscientists used brain scans to study people's brains while they made financial decisions. They found something surprising. A part of the brain associated with emotion was active when people made risky financial decisions. But what does this mean? And how can we use this knowledge to avoid getting caught up in the next financial bubble? We'll explore this further. The science behind financial bubbles is complex, but it's rooted in human psychology and behavior. When we're faced with a potential investment opportunity, our brains release dopamine, a chemical associated with pleasure and reward. This can create a feedback loop, where the more we invest, the more dopamine we release, and the more we want to invest. It's a vicious cycle that can lead to irrational decision-making and a disregard for risk. Researchers have identified this phenomenon as a key factor in the formation of financial bubbles, where prices become detached from reality. People start to make decisions based on emotion rather than logic. The South Sea Company bubble of the 18th century is another famous example of a financial bubble. In 1711, the company was granted a monopoly on trade with South America, and its stock price skyrocketed. People from all walks of life invested in the company, hoping to make a fortune. However, the company's actual profits were minimal, and the bubble eventually burst, leaving many investors ruined. This event was one of the first major financial bubbles in England, and led to changes in the way companies were regulated. It's a cautionary tale that shows how even the most respected institutions can get caught up in the excitement of a bubble. Scientists have made some surprising discoveries about financial bubbles in recent years. For example, a study published in 2018 found that people who are more prone to financial risk-taking tend to have a different brain structure than those who are more cautious. Specifically, they have a larger amygdala, a region of the brain associated with emotion and impulsivity. This suggests that some people may be more naturally inclined to take risks, and therefore more susceptible to getting caught up in a financial bubble. This knowledge could be used to develop new strategies for managing risk and avoiding bubbles. As we continue to explore the world of financial bubbles, we're left with more questions than answers. Can we really predict when a bubble is about to burst? Or is it always a surprise? And what role do external factors, such as government policies and global events, play in the formation and collapse of bubbles? The answers to these questions could hold the key to avoiding the next big financial disaster. But as we delve deeper into the mystery of financial bubbles, we're about to uncover a shocking truth that will change everything we thought we knew about the economy and human behavior. The story is far from over, and the next chapter is just beginning. Recent studies have shed new light on the science behind financial bubbles. In Arlene, a team of researchers used advanced algorithms to analyze market trends and identify patterns that could indicate an impending bubble. They found that by combining data on market sentiment, economic indicators, and social media trends, they could predict with surprising accuracy when a bubble was about to form. This discovery has significant implications for investors and policymakers, who could use this knowledge to make more informed decisions and avoid getting caught up in the next big bubble. Additionally, neuroscientists have made further discoveries about the brain's role in financial decision-making, including the finding that stress and anxiety can significantly impair our ability to make rational financial decisions. Despite these advances, there is still much that scientists don't know about financial bubbles. For example, it is still unclear what triggers the initial surge of excitement and speculation that leads to a bubble. Is it a combination of factors, such as low interest rates, economic growth, and technological innovation, or is there a single catalyst that sets the process in motion? Furthermore, researchers are still struggling to understand why some people are more susceptible to the allure of a bubble than others. Is it a matter of personality, upbringing, or something else entirely? These questions remain unanswered, and scientists continue to study the complex interactions between human psychology, economics, and technology that give rise to financial bubbles. The study of financial bubbles is not just an academic exercise. It has real-world implications for all of us. As we saw in 2008, the collapse of a bubble can have devastating consequences for individuals, families, and entire economies. By understanding the mechanisms that drive bubble formation, we can take steps to mitigate the risks and prevent the next big crash. This knowledge can inform policy decisions, such as regulating financial markets and implementing safeguards to prevent excessive speculation. It can also help individuals make more informed investment decisions and avoid getting caught up in the hype surrounding a bubble. By learning from the past and studying the science behind financial bubbles, we can build a more stable and resilient economy for the future. As we conclude our journey into the world of financial bubbles, we are left with a lasting impression of the complex and often surprising forces that shape our economic lives. From the tulip mania of the 17th century to the housing market crash of 2008, bubbles have been a recurring feature of human history.
each one a reminder of the power of human psychology and the importance of caution and prudence in financial decision-making. As we look to the future, we are reminded that the next big bubble could be just around the corner, waiting to burst and change the course of history once again. The story of financial bubbles is a timeless one, a cautionary tale that reminds us of the importance of wisdom, discipline, and responsible decision-making in the pursuit of prosperity and financial security.